You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Safestay, Tritax, Watches of Switzerland, Halfords, Supreme, and we don't actually have a US company of the week, but the closest of these companies is Fevertree, because it's growing out in the States and is now the number one tonic and ginger beer maker in the US. Sam, do you want to kick us off with Safestay?
Yes, it's a debut on the show. For anyone who is not familiar with Safestay, which I imagine is a lot of people, they basically run hostels and, hotels as well, but it's only one hotel they've got. So they've got a hotel in Berlin, and then they've also got hostels in Athens, Barcelona, Bratislava, Brussels, Cordoba, Glasgow, Edinburgh, London, Lisbon, Madrid, Pisa, Prague, Warsaw, and York. So they are listed on the AIM, and they've come out with their full year results, and they have reported record revenue of 23 million, and that compares to 22.5 million last year, and adjusted EBITDA of 6.5 million compared to 6.8 million last year. UK sales increased by 8% to 9 million, and they account for 39% of revenue generated. Overseas sales were down slightly to 14 million, which was a 1% decrease due to unfavourable movements in the euro. They had a reduced loss after tax of 0.9 million, and that's down from 1.4 million last year. And the available cash balance at 31 December was 1.4 million, and that was down from 2 million, which reflects the freehold purchases in Brighton and Cordoba made during the year and ongoing capital expenditure across the portfolio. The net asset value was 47p per share, and that compares to 50p a year ago. However, I'd take that with a pinch of salt just because the share price is 26p per share. So I'm skeptical they'd be able to realise that net asset value of 47p, especially in the worst case scenario if it was a fire sale and they were a distressed seller. They have reported a 10% increase in total bed nights to 931,000, and occupancy increased by 3.8% to 75.2%, supported by effective marketing investment. They reported a recovery in group bookings, which represented 16% of accommodation sales, up from 13% a year ago, and they successfully focused on maximising higher margin direct bookings, which represented 38% of sales, up from 30% a year ago. They've reported a 26% increase in non-accommodation spend, which helped to offset a 10% decrease in average bed rate, reflecting industry-wide challenging pricing environment. As a result, revenue per available bed was broadly maintained at £18.56. They've increased the tempo of the new acquisitions in line with the board's intention to double the size of the portfolio over the medium term. They currently have an international footprint of 20 properties, and that's up from 17 a year ago, and that includes 3 properties that are in development. And they've also surrendered the lease on their unprofitable Vienna hotel. They've also said, in terms of the overview, in 2024, we were pleased to welcome 447,926 customers for a record total of 931,688 bed nights, up from 848,000, driven by a strengthened occupancy rate of 75.2%, up from 71.4%, whilst average bed rate was decreased by 10% to £21.43, reflecting market-wide pressures on pricing. We were pleased to broadly maintain total revenue per available bed at £18.56. This was supported by our strategic focus on non-accommodation revenue, which increased by 29.8% year on year. Included within this, food and beverage sales increased year on year by 25.6%. They've said from April 2025, they think the increase in the NI and minimum wage will have an annual impact of £154,000 a year on the group. In terms of valuation, they don't have any earnings because they've been losing money. They have a market cap of just under £16 million, so it's a really small business. I think operationally, I don't think the losses look that concerning. There was quite a lot of debt, but when I looked at it, I think it looked fairly manageable, especially given it's actually backed by the properties anyway. But I think operationally, it seemed like things were generally moving in the right direction, but they've had that issue where they've had to drop the prices 10%. I just think in terms of hostels, obviously safety is very important. They do talk about safety a lot on the website, but I think a lot of other hostels will. But I just think a hostel, as long as it's relatively safe and it has kind of good reviews and stuff and a good reputation, it's a pretty homogenous product. I think it's really, really hard to differentiate yourself because like you are in the budget end of the market. And I think people will just go for the cheapest stay available. And they are not, when you look at where they've only got like 20 locations overseas, they're obviously not like a big international player or anything. So they're not really going to get those economies of scale either. So I just think it looks like they're doing a decent job with the business. It looks like it's heading in the right direction, but I would have some serious concerns about the industry. And also as well, it's just a lot smaller than I'd invest in anyway normally. But not that that's necessarily an issue, but it's just something to be aware of. But yeah, for me, it's probably not one I'd be interested in looking at again, just because I think it's such a cutthroat industry, and that 10% drop in prices that they've been forced into kind of reflects that. What about you, John?
Yeah, pretty similar, to be honest. I think what you say, operationally looks reasonable, but it is right at the bottom end of the market. It's very competitive. It feels like there's a lot of it sort of race to the bottom with it, and very, very price sensitive customers. You mentioned, is there any sort of USP? I mean, I think there can be some sort of USP with certain hostels, like you've got the generator hostels, which are that bit more premium. But otherwise, people are looking for the cheapest stay possible with reasonable safety. But again, I don't think you come across that many that are what people would consider unsafe. So, I don't really see anything attractive about this business. So I'd just be avoiding it, to be honest.
Right, should we move on to a business that we have previously found very attractive?
Yes, no, absolutely. So Tritax Big Box Company, they had their investor seminar last week, and I will read out some of the key highlights from it. So Tritax has the potential to grow adjusted earnings by 50% by the end of 2030, supported by its three growth drivers: record rental reversion within its investment portfolio of both big box and urban logistics assets, with the potential to add £79 million to the contracted rent. Significant logistics development pipeline with the potential to add over £320 million to the contracted rent. And thirdly, exceptional returns from large-scale pre-let data centre opportunities, with the initial two schemes providing the potential to add £58 million of contracted rent. Underpinning this growth is their efficient cost structure, strong balance sheet, and limited and gradual increases in financing costs. And they comment that their seminar expands on the opportunity with a focus on updating ongoing asset management initiatives, including within the attractive and complementary urban logistics market, the significant growth opportunities within Tritax's logistic development program and in its data centres, and prevailing market conditions for both logistics and data centres and their enduring structural drivers, which, combined with letting up vacancy, has the potential to add £79 million to the contracted rent. Logistics development pipeline delivering 6 to 8% yield on cost, with the potential to deliver £320 million of rental income. Commenting, Colin Godfrey, the chief executive of Tritax Big Box, said, "Today's investor seminar provides the platform to showcase the significant growth opportunities our strategic focus creates. With record rental reversion and attractive logistics development pipeline, and thanks to the innovative power-first approach, the potential for major data centres is both the breadth and scale of our opportunity, which is unique in UK real estate. These factors combine to give the ability to grow adjusted earnings by 50% by the end of 2030 and deliver superior risk-adjusted returns to shareholders." And the big news was that Tritax has reached an agreement with the board at Warehouse REIT to acquire the company in a deal valued at around £485 million. The offer will now be taken to shareholders for approval, and it's been recommended ahead of a rival bid from Blackstone. Under the terms of the deal, Warehouse shareholders will receive 0.4236 of new Tritax Big Box shares and 47.2 pence in cash per share, plus upcoming Warehouse dividends due in July and October. And Warehouse shareholders would hold around 6.8% of the enlarged Tritax business. The shares were down nearly 1.5% in early trading on the back of the news. In terms of valuation, Tritax has a market cap of £3.5 billion and trades at 7.2 times earnings, with a 10-year average of 12.8 and a prospective dividend yield of 5.3%. I don't think there was a huge amount new in terms of the seminar, but it's the big news about Warehouse REIT, and I suppose it's to some extent what you think about that. I think going back to the current business and looking at the logistics, I think that's very, very positive, and that's definitely a growth area. I think data centres also a growth area, but I think the jury's out perhaps on just how big that's going to be in the UK in the near term, and that's largely down to energy prices. And from a layperson's perspective, my basic understanding is that the cheaper the energy you have available, the more economic data centres are going to be. And that's not to say that there can't be any data centres in the UK, and proximity to them is something that can be very important in business and in trading. But I think that's something inherently that Tritax in the sort of medium term has against it, in that there are very expensive energy costs in the UK compared with some peers. In terms of the Warehouse REIT, it does make sense. It's a logical acquisition for Tritax, and I think if they are going to beat Blackstone to it on what looks like a fairly reasonable offer, I think that makes a lot of sense. And certainly at 7.2 times earnings with decent growth ahead of it, I don't think it's expensive at all. And as a REIT, obviously it's got to pay out a certain proportion as a dividend, but 5.3% is pretty good. So I do still like Tritax. It is still on the watch list. I suppose one thing that not puts me off, but that I'm conscious of, is that I've already got one REIT, which is a decent part of my portfolio, which is Supermarket Income REIT, and I'm not sure whether I'm just ready to add another one right now. Sam, what are your thoughts on Tritax Big Box?
I like it. It's also on my watch list. I think initially, I don't know as much about Warehouse REIT as I do about Tritax, but initially it does look like quite a good fit. I agree with your point that how valuable are the data centres. And I know there's a proximity benefit, but we also have like the highest energy costs in Europe. So it's, besides the businesses that want it for proximity, you wouldn't think it's going to be that much more of a growth market based on current conditions. But I think overall, I do really like Tritax's portfolio, and it's not this, if you compare that to some other REITs where it's just a lot of like sort of traditional high street and stuff like that, it is just kind of the industrial buildings that you think actually someone's always going to want to let them. If you kind of pick an average sample of buildings in the portfolio, they're usually very desirable locations, just off of motorways, that kind of stuff. So I like it. I think it's a decent discount to net asset value. I know that REITs usually do trade at a discount to net asset value, but if you actually look at it from listing, it usually had actually, for the first kind of 7 years, probably until like just after COVID, it had always sort of hugged the net asset value much more closely. And then what happened was in COVID, because it was the type of business it was, and you obviously had all the internet stuff taken off, it went quite high on the back of that, and it overtook the net asset value. A lot of the net assets were then subsequently, I think, revalued higher than they should have been, and they've come back down. So yeah, I like it. I think the yield's good. I also own Supermarket Income REIT. I think for me, it's definitely something I'd consider, but at the moment it's probably the opportunity cost. And I think I do just find Supermarket Income REIT a bit more exciting. Now, there's certain other things in my portfolio where if they weren't there, it's probably Tritax is pretty high up on the watch list, but it's never quite made it into the portfolio. So I think pretty similar situation to you.
Fine. Okay. How are Watches of Switzerland doing? We haven't checked in on them in a while.
No, we haven't. So for anyone who's not familiar, well, obviously they sell watches, but in terms of the way they do it, it's very much put themselves at the premium end of the market. They do kind of have like a showroom environment. So they kind of try and create this experience that's a lot more like buying a car. So they have come out with their full year results, and revenue was up 8% overall, and that was made up of 16% revenue increase in the US and 2% in UK and Europe. In terms of the split, the US revenue is now at 786 million, and that compares to 866 for the UK and Europe. When you factor in that growth rate, in a year or two, the US is probably actually going to be the largest market for it. Adjusted EBITDA was up 8% to 192 million, and the adjusted EBITDA margin was flat at 11.6%. Operating profit was down 5% to 114 million, and the earnings per share were down 9% to 22.8 million. The free cash flow was down 17% to 98 million, and the free cash flow conversion was down from 66 to 51%. And the return on capital employed was down 0.5% to 19%. You've said luxury watches revenue increased 2% in constant currency, 1% reported. Demand for our key brands, particularly products on registration of interest lists, remained strong, outstripping supply in both the US and UK markets. Certified pre-owned and vintage is performing strongly, with Rolex certified pre-owned becoming the group's second largest luxury watch brand equivalent. Luxury jewellery revenue is up 108% in constant currency and 106% reported, driven by the acquisition of Roberto Coin Incorporated. Luxury branded jewellery delivered double-digit growth. And they said they've made excellent progress with showroom expansion and refurbishment programme. Expansionary capex of 73 million, with 4 new showrooms opened and 11 refurbished or expanded. Net debt was 96 million at 27th of April, and that was worsened from a net cash position of 1 million. And they've said that reflects the acquisitions of Roberto Coin and Hodinkee business. On 10th of March, the group launched a share buyback program of 25 million, and that is on a market cap of 867 million. However, they don't pay a dividend, so the buyback effectively is the dividend. In terms of the outlook, they have guided for constant currency revenue growth of 6 to 10%, adjusted EBIT margin of flat to negative 100 basis points versus the prior year, and a capex of 65 to 70 billion. They've also said the outcome of US tariff developments remains uncertain. We're in regular dialogue with our brand partners, but it's too early to comment on the potential sector impact of further changes. I think when you look at the business overall, it's not done terribly. The revenue's compounded at like 10% a year. Earnings have grown an average of about 24%, which is very good. Net margins have increased slightly, and they have really they were 10 years ago much more UK centric, whereas now the US is nearly half of sales, and it's probably going to become the majority in the next year or two. However, they've done that through acquisitions, which I don't necessarily disagree. I've got no issue with acquisitions. But they bought 17 stores of Mayors in 2017. Then they bought luxury watch and jewellery stores in the Betteridge brand in 2021. They bought Analog Shift in 2021, which was pre-owned and vintage watches. Ernest Jones in 23, which was 15 luxury showrooms in the UK. I don't have an issue with that one because I think that actually ties in very well with what they're doing already. And then Roberto Coin this year, but they've taken on quite a significant amount of debt in order to do it. Although when they're at the net debt of 97 million, how does that compare to the EBITDA 192? Yeah, so in fairness, the debt's probably still at a pretty manageable level. And in terms of the valuation, the business trades at a P of 9.3. I think one issue is when you look at all the acquisitions they've done, in terms of the net income and the cash as well, it's not really significantly changed the amount of cash they're generating. It's pretty similar. Like the free cash flow's not really moved a lot. And I know that there's a lot of capex going on and stuff, but it doesn't really seem like the strategies. It might have made the business bigger, but I don't know if it's necessarily actually rewarded shareholders that much. But yeah, I think it's a decent business. I think the strategy seems quite good. And I do quite like the showroom aspect of it and sort of making more of an experience of it, which I think is probably necessary for that kind of higher end watch purchases. But I just think, other than continue to buying more stores in the US, the organic growth isn't really that impressive. And I think that's because it's quite hard to differentiate. It's quite a saturated market here and in the US. And yeah, I think they seem to be a pretty decent operator, but if they're just going to have to keep buying different US businesses, that might work very well for them. But I think as a shareholder, I just don't necessarily see how that leads to like a market beating return. What about you, John?
Yeah, I would largely echo what you've said, Sam. I think the other thing, as we've seen with some of the other big consumer goods companies, is moving towards direct to consumer. And obviously, as brands do that increasingly, which I think does apply to luxury brands too, that does cut out or cut down on what Watches of Switzerland are going to be selling. And I know they're much more expensive to buy the brands themselves, but you come back to companies like LVMH, and yes, it's probably at least twice as expensive to buy, but I'd feel much more comfortable owning the brands rather than a retailer like Watches of Switzerland?
I guess to counter that, I'd probably say that, I guess with watches, there's a huge second-hand market, which I think they still benefit from. And they've also got the jewellery. I think the issue is that if you are looking for any of these expensive products, there's a benefit to going in store, especially if you're buying it second-hand, because you want some kind of certification that it's real, I think, in most cases at that level. But I think the issue is every high street has somewhere like that. There's not necessarily a reason you're going to pick Watches of Switzerland unless it's the closest. And I think for me, that's probably the biggest issue. Because although they talk about like a showroom experience, which I think it needs to be at that kind of price point, when you go back past a lot of nice watch shops, they're all pretty similar.
Yeah. Not one for you?
I don't think so. Yeah, I just don't see how you'd get a market-beating return from it.
Shall we move on to Halfords?
Yes, another business I don't see how you get a market-beating return from.
Okay, so Halfords, for anyone who doesn't know, it's a bike retailer, but they've moved into automotive centres and garages more recently. They had their preliminary results out for the 52 weeks to the 28th of March for what they say is a strong financial performance, with revenue up 0.1% to 1.7 billion. And if we break that down into the auto centres versus the retails, the auto centres were actually down 0.8% and the retail was up 0.8%. The retail is still the bigger division at around £1 billion worth of revenue compared with 710 in the auto centres. Gross margin improved by 2.5 percentage points to 50.7%, and underlying profit before tax came in at £38.4 million, which is up 6.4%. Strong financial performance with group sales of up 2.2% on a like-for-like basis and 6.4% growth in profit before tax to £38.4 million, above the previously guided £32 to £37 million range. 250 basis points of gross margin expansion year on year, £35 million of cost savings, and £43 million of free cash generation, up from £29.4 million for full year 24, as momentum grew through the second half and ended the year with balance sheet net cash. Total dividend increased by 10% to 8.8 pence in line with policy, and 50 Fusion locations are now trading and are on track to double garage level profitability at maturity, with an average payback period of around 2 years, improving the garage experience for customers and colleagues and more closely linking the motoring assets within a town. Membership of Halfords Motoring Club now exceeds 5 million customers, and Henry Birch has been appointed as the chief executive in April, with new managing directors appointed to run the retail and auto centre businesses. And Harry Birch has come in and said that I'm very pleased to be announcing a positive set of results for Halfords. The business has delivered a strong financial performance, has made good strategic progress, and has a clear plan in place to tackle external inflationary forces. Halfords has a unique combination of retail stores, garages and mobile vans, a trusted brand, scaled omnichannel infrastructure, and access to valuable proprietary data. It's an exciting time to be joining, and I see significant potential to optimise and grow this fantastic business. And in terms of the current trading and outlook, trading in the early weeks of full year 26 is in line with expectations. As previously indicated, we plan to offset another year of elevated inflation in full year 26 through a combination of pricing, buying, and cost opportunities. We continue to be somewhat cautious on the outlook for consumer spending. We remain committed to a strategy emphasising motoring services across our unique combination of retail and auto centres, the successful execution of which will enable significant value creation in future years. Accordingly, we will make further progress towards our target of 150 Fusion garages, delivering at least 60 in full year 26 and the balance in full year 27 with an average capex of around £200,000 per site. In full year 26, we will continue to invest in Halfords Motoring Club, our digital consumer experience, and contact centre technology and systems and leadership capability across the business. In terms of the total, so reported loss before tax for the full year 25, it came in at 30 million. Okay, so in those figures, if we break them down a little bit more, so there's an impairment of non-current assets, mainly non-cash goodwill, write-down across the retail segment, prompted by higher discount rate in forecasts, reflecting increased gilt yields and national living wage expectations, closure costs of £14.9 million, tied to the strategic wind down of underperforming garages and stores as part of the garage optimization program, and £2.9 million of migration to the cloud server infrastructure, organisational restructuring costs of £1.5 million related to the warehouse management system replacement. Okay then, so that's how we get to the statutory headline loss of 30 million. In terms of valuation, Halfords has a market cap of £326 million and trades at 10.8 times their forward adjusted earnings, compared with a 10-year average of 10.9, and it has a prospective dividend yield of 6%. I've made it very clear that I'm not a fan of Halfords. I think the group strategy and pivot towards the auto centres in the longer term, well, even now the revenue is falling, but I think in the longer term, as there is more of a move towards electric cars with fewer serviceable parts, I think it's something that has the potential to go in structural decline there. Yes, tyre sales may be reasonable, but I don't think they can underpin that complete pivot towards it. And also, I think that you see a lot of people, and particularly in the UK market, will buy cars on finance and will often have servicing plans tied in, which are generally with the brand or the dealership that they've bought with. So again, I don't think that lends itself towards the auto centres. And I think thirdly, increasingly, there seems to be more, cars seem to be more locked down to dealer centre tools. And again, that's not something that Halfords may have as much access to compared with the dealer themselves. So again, it limits the servicing potentially that they can do. Again, the retail, it's very tough. Obviously, they had a very good time with the post-pandemic boom and people buying bikes and being essentially locked down in the UK, and did very well out of that. That's been much more challenging over the last couple of years. And I think as well, you're seeing those staffing costs, minimum wage up, national insurance hikes. That's all going to, it is already hitting the group. But I think that's a big concern going forward too. So I still feel that Halfords is uninvestable, and I think the strategy that it's adopted isn't the right one. So I wouldn't be touching Halfords with a barge pole. Sam, what are your thoughts?
I think these results are mixed. I think the cost cutting's good, but the strategy they were talking about a year or two ago, they shouldn't really be relying on cost cutting. Obviously, if there's synergies and stuff from stuff they bought, that makes sense. But like you say, the growth isn't there. So it's not like it's being done alongside the growth. That being said, I think one glimmer of hope, I say glimmer of hope, it's a fine business. I just think it's a pretty average business. But in terms of, I think one thing that potentially would be worth getting excited about is the fusion garages. I actually think if you have a garage near a Halfords that's going there for parts, and also the Halfords can kind of send people to the garage, so it's got this flow of customers, I actually think they could do quite well. And the fact that they've got a payback period of 2 years suggests they are. Now, it's currently a small base of 50, but then if they've been buying these auto centres and stuff, how many of them, if they're shutting the underperforming ones, and there might be some capacity to convert a lot of them. But I think the fusion garages, where it's basically just an extension of Halfords and they're just sending all these customers out, I think that could work very well. I appreciate what you've said, John, about the transition to electric vehicles. I mean, I think there's still going to be quite a big second-hand car market for a long time, as long as it's not legislated away by the government. But even so, if the payback's 2 years, they could still do very well on it, because I think that's still a number of years away. The thing is, how many of these Halfords stores does it work for? Because it's got to be certain big locations and stuff, and it's got to have the volume of people. But the fusion garages, I think, actually seems quite encouraging. Is it encouraging enough that I would invest in the business? Absolutely not. But I think they could potentially do fairly well off that, and I think it's better than just kind of random standalone ones that they've bought. Whether this was already part of the plan, always part of the plan, and I've just never understood it. But I do think the Fusion garages maybe gives a little bit more to get excited about than previous years.
Okay, on to Supreme.
Yes, so this is a business that I am a shareholder in, and they do a lot of different things actually, but they over 50% of the revenue historically has come from vaping. So they have this figure's a few years old, so it might be incorrect now, but certainly a few years ago they had a 30% share of the UK vaping market by volume. They also do loads of other stuff. They've got like a vitamins and minerals business. They do a lot of stuff to do with like lighting and batteries. They've got like the Duracell and Energizer licenses for the UK. They've got sort of the tea business. They bought Typhoo Tea recently. So yes, they've got a lot of kind of quite random things, but they all seem to work very well together. But I won't go into too much detail because we have covered it before. But Supreme have come out with their full year results, and revenue was up 4% to 231 million. Gross profit was up 16% to 73.7 million, and the gross profit margin was up from 29 to 32%. Adjusted EBITDA was up 6% to 40.5 million. Earnings per share was up 5% to 20.1p a share. Adjusted earnings per share was up 3% to 21.6p a share. Operating cash flow was down 7% to 25.1 million. And net assets was up 32% to 76.5 million. And adjusted net cash was down 90% to 1.2 million. And net debt worsened from 3.1 to 12.3 million. However, that's mainly due to acquisitions. It's not great to see, but when you look at the profitability, it's a very small amount of net debt, and they tend to buy businesses that have payback periods of 2 or 3 years. So I'm not particularly bothered about that. And they've said the revenue growth was thanks to acquisitions plus strong sales traction across product mix with our vaping products, both owned and branded, now reported under a unified category, continuing to perform well. Drinks and wellness doubled to 48.8 million, boosted by the acquisition of Clearly Drinks and Typhoo Tea. They've said the gross profit margin increase was as a result of increased manufacturing across the group, with the addition of Clearly Drinks, as well as efficiencies across the business. They have successfully relocated to a new purpose-built head office and operational hub in Trafford Park, Manchester, reflecting the scale and ambition of the business. They've renewed a £40 million borrowing facility to continue to underpin ongoing investment in strategic acquisitions and innovation-led growth initiatives. They've announced a final dividend of 3.4p a share and paid an interim dividend of 1.8. So that would take total dividends to 5.2p a share, which is a 10% increase on the prior year. They've made a positive start to the 2026 year and expect to deliver another profitable and highly cash-generative year, trading in line with current market expectations. I would add as well, in terms of that dividend, when they're taking on debt, unless they've got it at a really good rate, which I just struggle to see in the current environment compared to 2 or 3 years ago, I'm pretty comfortable with the acquisition strategy. I kind of trust them with the money. I'd rather they just didn't pay me a dividend, to be honest. They just went and used it to go and buy businesses. They've said they're trading in line with current market expectations. And if we go into the different divisions, for vaping, they've said the group's vaping activities, which include own brand sales along with the branded Lost Mary and Elf Bar products, who they do the distribution for, remained stable with sales of 129 million, and that was down from 140 million the year before. They reported revenue of UK disposable vapes of 54 million, and that was down from 70.7 million the year before. So I think it was January that the disposable vape ban came in. So that's why that's taken a dip. This performance was anticipated and in line with our expectations as the business prepared itself and its retail customers for the recently implemented UK ban on disposable vapes. The quality of the earnings has not been compromised, as evidenced by the strong gross margins year on year and disciplined stock management strategy, meaning that the group does not require any extensive stock provisions this year end to protect the business from any profit exposure. Non-disposable vape activity continues to be strong, with the business delivering growth of 8%. In drinks and wellness, they've said that's been formed by combining the existing sports, nutrition and wellness category with the soft drinks and hot beverages businesses. Both revenue and gross profit grew 5%, driven in part by further gains from the principal MX brand, which they acquired in 2022. In 2025, revenue from Cymax totaled 10 million, and they only acquired the brand for 1.4 million 3 years ago. They acquired Clearly Drinks in 2024, and it allowed them to expand into the wellness drinks market, in which protein and vitamin-infused drinks are gathering sizable traction with consumers. By merging Supreme's entrepreneurial drive and expansive customer network with Clearly Drink's £20 million revenue base, generating an almost 40% gross margin across contract manufacturing and its own soft drink and bottled water brands, Supreme is now unlocking significant cross-sell opportunities. So a lot of the Supreme products, they will be in like B&M, Heron Foods and stuff like that. So what's quite good about it is once they kind of get a new business, they're able to basically start selling it in the other places that they've got all their other products. So that's partly why these acquisitions work so well, because of the amount of cross-selling. And it's also interestingly, it's one of the reasons why they bought Thai Food Tea, which I'll come on to in a bit. But like Thai Food Tea, obviously they are in a lot of shops. So potentially Thai Food gets them in with a lot of retailers they're not currently in with. So it allows them to cross-sell some of their other stuff. So in November 2024, Supreme entered the black and herbal tea market through the acquisition of Thai Food Tea out of administration. Supreme's intention is to realign the brand pricing and flavour profile to suit mainstream distribution, as well as bring manufacturing back in-house. By integrating Thai Food's rich portfolio with Supreme's soft drinks and sports, nutrition and wellness categories, the business has now been able to capitalise on sales, marketing and product innovation opportunities. Our teams are now focused on expanding product listings across supermarkets, discounters, wholesalers and online platforms. We're focused on developing our own label or license offerings under established brands, mirroring Supreme's proven track record across the batteries and lighting markets. Most importantly, the acquisition has broadened our UK retail footprint, enabling us to develop new relationships with even more established high street names, including Holland and Barrett. For the year ended 30 September 2024, Thai Food Tea reported revenue of 20 million and a loss before tax of 4.6 million. In the 4 months under Supreme's ownership, the business reported revenue of 6.1 million and contributed positively, albeit modestly, to the group's adjusted EBITDA. So that's quite a turnaround so far in quite a short period of time. And in the electricals business, batteries and lightings had a modest revenue decline of 6%, reflecting the longer-term trend across these categories and the ongoing cost challenges facing consumers. In terms of valuation, the business trades at a P of 8.5 and has a dividend yield of just under 3%. And that's despite, well, actually it says the shares are only up 6% this year, but they did have quite a dip and they've really rallied actually, but over 3 years they're up 44% and 2 years are up 74%. As a shareholder, I think this is a really good set of results. I think we all knew the disposables ban was coming. They kind of just shrugged it off. I know it's only been in for 3 months, so it's next year it will fall into, but there is more of a refocus in terms of the wellness side of the business and the drinks and the energy stuff, well not the energy, the nutrition stuff. They are becoming more diversified and less dependent on vaping. And the only reason they've become so dependent on vaping in the first place was because it performed so well for them. But even still, I think a lot of the people who were on disposables are just going to switch to non-disposables. You've also got the pouches, which you're now starting to see pop up in, like, if you go to a B&M or a Heron Foods where it is 88 vape products, they've now got the pouches as well. So it's, that'll start kicking in too. But yeah, very, very happy with the performance. Very, very happy with the strategy. My only niggle would be that as a shareholder, I don't actually want the dividend, because I think, if you look at what they've done with Thai Food Tea in such a short period, what they've done with some of those other examples that we gave of acquisitions, I think they can invest the money better than I can with a dividend. So I would rather not have it, but that's my only complaint. John, what are your thoughts?
Yeah, no, I think the acquisitions seem to be really smart ones. I think Thai Food particularly. And yeah, at the current valuation, it certainly looks cheap. And they're in a prime position in the market in terms of their share of the vaping industry. Depends what you think of that, I guess, from an ethical perspective. But yeah, they seem to be a great operator overall, and you certainly wouldn't bet against them in terms of the acquisitions and delivering on that future growth.
Shall we move on to our US focused company of the week?
Yeah, so it's the UK listed company Fevertree. It's AIM listed, and they had a trading statement out last week with the group so far in 2025 meeting expectations, but momentum in the US has been strong, with underlying brand growth remaining ahead of the competition. European growth continues to deliver good momentum across multiple markets. However, sales in Germany were more muted. As part of the partnership agreement, Fevertree's and Molson Coors will equally share 10% of US tariffs on UK imports, and they're actively working together to mitigate the short-term tariff impact. The group said that it remains comfortable with its full-year expectations of low single-digit revenue growth and underlying cash profit EBITDA margins of around 12%, and around £42.5 million of the ongoing £100 million share buyback has been completed. And the shares were broadly flat in early trading. In terms of valuation, Fevertree has a market cap of 1.15 billion and trades at 35 times forward earnings, compared with the 10-year average of 44, and it has a prospective dividend yield of 1.9%. I think the main story, as you alluded to here, is the growth in the States, and that so far has been going very well. They're the number one tonic maker in the US, and they're also the number one ginger beer maker in the States too. I think that really accounts for that fairly toppy valuation, in the sense that in the European markets, and particularly in the UK, sales are generally flat there, and they pretty much have reached saturation points in the UK. I think it's interesting as well that they are diversifying. So now, if you zoom out, 45% of group sales actually come from non-tonic mixers. So whilst that's still the biggest part of it, they are growing into sort of cola, and ginger beer is another example. So I think that's also a positive for the group. And I think with the distribution and the power of cause behind them, that's just helping for that US conquest, which is fantastic. I guess it does come back to the valuation that, yes, it's cheaper than it has been over the last 10 years or since listing, but it's still 35 times forward earnings, so it is expensive. I do like Fevertree a lot. I know you own shares, Sam. I haven't quite got there yet, but I'm certainly getting closer. What was your feeling on the back of this trading statement?
Pretty happy. I mean, it wasn't a huge amount of meat on the bone with the statement, but I think for me really it's more about the US. I think if they can crack that, and I think with a core deal, I think they've got every chance of doing it. I think it's a really, really smart partnership. I think as well, I think the buyback, they've been pretty aggressive with that. If you look at the share price, I think they've bought back shares at a very attractive price. So I think that's been very good for the shareholders that have kept the shares. I think in terms of the valuation, I think the part of the reason I'm so comfortable with it is if you look at the earnings over 5 years, they're down. If you look at what they were compared to their peak, they're down, getting on for like 40%. So if you look at it on a normalized basis, it's probably more around 2025, which I think, given the opportunity in the US, plus as well the potential expansion of the actual range of what they're selling itself that you've alluded to, the US is already now their biggest market, and it's still growing because they've had to go and create that market, whereas in the UK, they've had to go into what was an existing market. But I think that means in the US it's much more exciting because you don't actually know how big that market could get. So yeah, so I think on a normalized, I say normalized, I mean, the glass costs went up and have never come back down. But I'm assuming at some point that will happen. But if not, I still think with the US opportunity being so good, I'm pretty comfortable. And I do think at some point the glass cost will come down. But that's coming from a perspective of I know nothing about glass. So maybe take that with a pinch of salt. But yeah, I'm pretty comfortable with it. But I think I'll be more excited in a year or two because I think obviously the course deal is pretty new. And I think it's going to take a while before that ramps up. But I'd hope to see that US growth accelerate.
Fair enough. Of the companies this week, Sam, what would be your top pick and what would be last?
I think top pick for me, although I'm very happy with Fevertree, which I also own, I do like Tritax a lot as well. But I think for me, it's quite easy. I think it's supreme. I think they've done really, really well with that disposable ban. It's not really impacted these results when it could very well have done. And I like the way they're pivoting. I like the acquisition strategy. And I think the valuation's still pretty low. I think the bottom pick's quite easy. I think it would just be Safestay. I think it's partly the industry, but it doesn't seem to have that much of a USP. The size would concern me anyway, because it's kind of getting to a level where you might not even have a huge amount of volume if you try to sell it. So you can see that in the spread, actually, in terms of the cost to buy shares versus sell them. But yeah, it's both fairly easy decisions for me this week. What about you?
Oh, it's, I think, a bit tougher, actually, because I'd have Fevertree and Tritax up there. I'd probably sleep easier with Tritax, so that would probably be my top pick. And then last, it might be Safestay, but Halfords would be a close second. Be in relegation too.
Yeah, do a playoff.
Okay, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.